All right, let's dive into one of the most powerful and classic chart patterns out there, the cup with handle. Seriously, if you want to get good at spotting stocks that are coiling up for a potentially huge move, this is one pattern you absolutely need to have in your toolbox.
Think about it. A stock has a great run, right? But then it has to take a breather, it has to consolidate. So how can you tell the difference between a stock that's just taking a rest and one that's building a launch pad for its next explosive rally? That, my friends, is the million-dollar question this pattern helps us answer.
And believe it or not, the answer, the clue, is often hidden in a shape you see every single morning, your coffee cup. This right here is the cup with handle. It's what we call a bullish continuation pattern, and it's a huge signal that a stock is getting ready for a potential breakout. So let's break it down piece by piece.
Okay, here's our game plan for today. First, we're going to dissect the anatomy of the pattern itself. Then I'll give you a super strict checklist so you can avoid all the fakeouts. After that, we'll look at its actual performance numbers, talk about how to trade the breakout, and then we'll finish up with some master's advice for finding only the best of the best setups.
First up, let's deconstruct this thing. You really have to understand its two distinct parts, the cup and the handle. Getting this right is the absolute foundation for spotting it and trading it correctly.
The first part is, you guessed it, the cup. This shows up after a stock has already had a strong run-up. What we're looking for is this nice, rounded, U-shaped bottom. Now, the shape is absolutely critical. See, a U-shape shows a nice gradual consolidation, a slow transfer from nervous sellers to confident buyers. A sharp V-shaped bottom? That's way more chaotic. It suggests panic selling and a snapback rally, which is a much shakier foundation for the next leg up.
And then comes the handle. So after the price moves up the right side of the cup, it hits a bit of a wall, some resistance, and it pulls back just a little. This handle is the final quick consolidation. The price might drift down a bit, maybe sideways, and ideally you want to see volume get lighter here. This is basically the market's way of shaking out any last-minute nervous investors before the real show begins.
Now, listen, not every chart that looks kinda like a teacup is a real signal. To avoid getting burned on false breakouts, you have to be disciplined. So that's why we're going to go through a really strict checklist to help you separate the high probability patterns from all the imposters out there. Sticking to these rules is non-negotiable, okay? Number one, there has to be a prior uptrend of at least 30%. Remember, this is a continuation pattern, so it needs a trend to continue. Two, like we just talked about, the cup needs that gentle U shape, not a sharp V. Three, timing is key. The cup should form over a period of about 7 to 65 weeks. 4. The handle has to form in the top half of the overall pattern. And finally, number 5. The two peaks on either side of the cup, the lips, they should be pretty close to the same price, creating a clear resistance level that needs to be broken.
And this just shows you the difference perfectly. On the left, you've got a beautiful, valid pattern that meets all the rules. But now, look at the one on the right. Sure, it kinda looks like a cup, but it fails one of the most important tests. There was no strong 30% uptrend before it formed. And guess what happened? The pattern failed, and the stock fell apart shortly after. See, discipline is everything in this game.
So, we've got the theory down, but here's the big question. Does this thing actually work? Does it make money? Let's dig into the actual numbers and see what history tells us about its performance.
Well, according to a ton of backtesting, when you're in a bull market, the average price rise after a clean breakout from this pattern is a whopping 34%. That really shows you just how much power can get stored up during that long consolidation.
Now let's talk risk, because that's just as important. The break-even failure rate for this pattern in a bull market is only 5%. Let me put that another way for you. It means that only about 1 out of every 20 valid patterns fails to gain at least 5% after it breaks out. That is an incredibly good risk profile, and it's a huge reason why traders respect this pattern so much.
But we do have to be realistic about our targets. Even though the pattern is super reliable, only about half the time in a bull market does the stock actually reach its full measured price target. And in a bear market, that number drops way down to just 27%. So what does this tell us? It tells us that being smart and taking some profits along the way is a really good idea.
Okay, so you've spotted a textbook setup. It follows all the rules. What do you do now? This is where we get tactical. Let's put together our actionable playbook for how to trade the breakout, how to set your targets, and, most importantly, how to manage your risk. The classic method for setting a price target is called the measure rule, and it's actually really simple. You just measure the depth of the cup, from its lowest point all the way up to the rim.
Then you take that same distance and you project it upward from the point where the stock breaks out. And there you go. That gives you a logical, data-driven target for the move.
But here's a pro tip. If you want a more conservative target, one with an even higher probability of being hit, just use half the cup's height instead. The data shows that this more modest target is reached an incredible 76% of the time in a bull market. Now that is a much more reliable number to work with, especially if you're a bit more risk-averse.
Let me be crystal clear. No pattern is ever foolproof. That's why risk management is absolutely essential. Your stop loss is your safety net. And the most logical place to put it is just a little bit below the low of the handle. Why there? Well, because if the price breaks below that level, it completely invalidates that final consolidation. It's telling you the setup has failed and it's time to get out with a small, manageable loss.
All right, to wrap things up, let's distill all of this down to what the real pros look for. Beyond the basic rules, what are those subtle little details that often separate the pretty good setups from the truly great ones?
Here is your cheat sheet for finding the absolute A-plus setups. Historically, the patterns that perform the best have tall cups and really short, tight handles. A big confirmation is seeing a U-shaped volume pattern where volume dries up at the bottom of the cup and then really expands on the way up the right side. And of course, the most powerful signals always show up when the overall market is in a healthy uptrend.
And I want to leave you with this piece of timeless trading wisdom. Finding a great entry point is only half the battle. Every single moment you hold a position, you are exposed to risk. You have to be disciplined. Know your profit targets before you even enter the trade and then stick to your plan. Don't let a great winning trade turn into a loser because you got greedy.
So there you have it. We've gone through the anatomy, the rules, the stats, and the trading plan for one of the most reliable patterns in technical analysis. But now the real work begins for you. Start pulling up charts. Start training your eyes to spot these formations in the wild. That's how you go from just knowing the theory to actually having a real valuable skill.